Welcome, everyone. My guest today is Lead Analyst Logan Mohtashami to talk about housing data, mortgage rates, and that very interesting tweet from Trump about Fannie and Freddie. First, I want to say thank you to our sponsor, Rocket Close, for making this episode possible. Logan, welcome back to the podcast.
What a great day. We have so many topics to talk about today, and this week has been fun. Like for nerdy economic people, this week has been fun. There's been a lot of things that have been talked about that I'm just having so much fun with. But yeah, I'm ready to go.
Okay, well, let's start with, because I know we have a lot of topics. Let's start with the housing data for this week.
So one of the things that, of course, what we track is purchase application data, and we track it a little bit different than everybody, but it's part of the tracker. And it's also a very confusing data line at times. So when we wrote that article yesterday, we try to make sense of it. Purchase application data is now up 16 straight weeks. The last 3 weeks are now up double digits year over year. Now, purchase apps look out 30 to 90 days. So it might take even 2 to 3 months before it actually even filters into the existing home sales report. But because of what happened last year, it gave a very, very low bar. Last year, the data was very negative. 14 out of in the first 18 weeks of the year, starting from the end of January, we had 14 negative prints, 2 flat, 2 positives, no year over year. Home sales weren't crashing or anything. They're just hovering around here. And that's what existing home sales have been doing. It's just been hovering. So because we had such a low bar and because the 10-year yield actually fell to start the year after January 14th, we're showing year over year growth. So we get a little bit more mortgage buyers. It looks like cash buyers are down a little bit, but this is all happening with elevated rates. So new listings data is growing. And then what we see is with active inventory, new listings data, and mortgage demand slightly up with elevated rates, you cannot ask for anything better considering what we have to deal with, right? If mortgage rates were down to 6% and we saw this data line, it wouldn't have been that big of a deal. But every year wages grow. Every year households form. Every year when you're working from very, very low levels of demand, historical low levels of how I call it, the lowest home sales ever. When you have that backdrop time, as long as price growth cools down, right, you're building in a better affordability case, because I can't still, as always, can't go under 5.75 in this environment for mortgage rates until the labor market breaks. But what happened with the unhealthy housing market mid-2020, it's funny because we were going back to our tweets. Sarah Weir, literally in May, we looked at May 21st, 2020. And I'm sitting there thinking, oh my God, home prices are too strong. Nobody understands what's going on. We did this whole thing back on May of 2020 when everybody was still in depression mode. It just shows how untalented people are. By the way, I encourage everyone, come to our YouTube page, HousingWire Daily. We have a YouTube page. We are going to get these scrub guys underneath in the comment sections to do a live debate and get their names and faces. And homie, Chart Poppy's going to make a man out of you. You're going to go back to your wife and you're going to say, Chart Daddy did it, man. I'm not a coward anymore. We're going to talk and we're going to do forecasted modeling. But it's really interesting now that why I'm happy is that I'm finally getting the balance, the supply and demand equilibrium balance. And that's what the existing home sales report showed. Again, inventory is growing, right? We're a little bit ahead of them, but it's catching up to us. And you could not, considering where rates are, this is what you want. If home prices, if it was like 2023 was terrible. New listings data, all-time lows. Inventory wasn't really growing. Sales were low. Price growth ended up almost 6%. No, that you get no advantage, disadvantage, or no advantage in that situation. But here, it's going, right? And what we've always said, it reminds me a lot of the 1980s, except the 1980s had 2 recessions and mortgage rates fell. But you put yourself in a better backdrop for the future. And whenever you have an explosion of prices, especially in a qualified mortgage world, that supply and demand equilibrium needs to be fixed. And it could only happen if you're part of team higher rates. So good. So far this year, and the fact that purchase apps are still positive for 16 straight weeks shows that that underlying demand curve is there. If you had rates near 6, like we could do 6, we've done that before a few years, you get more demand growth. We saw that data better last year when mortgage rates headed towards 6, and our forward-looking pending sales data was getting better, and applications were getting better itself. So I could see that. I can see that tunnel right there. It's getting, and it's just positive in that light, which a lot of people, it sounds weird for people to say that, but I'm not a fan of 2020, 2021, and early 2022. More of a fan now, because this thing's going to be here for decades and decades to come. You've got to find that balance and that equilibrium.
Okay, so first of all, you called yourself Chart Poppy, and I will not
Chart
have
Poppy. Oh yes. By the
No.
way, to the person the person who came up with that name too, good.
No, okay, it sounds like you've gone from Chart Daddy, and now you're older, and now you're the Chart Grandpa, Chart Poppy. I don't know.
No. People, when people hear the term Chart Poppy, they know what we're talking about. So that was a good nickname. We are getting all these good nicknames and stuff this year. So
Okay, so this is another one that's going over my head. I'm like, I don't know what that is. Okay.
That's because you're an elderly Gen X, Sarah Wheeler.
I am a proud elderly Gen X. I will take it. Okay, so I think one of the things that you mentioned in there, but did it pretty quickly, was the inventory situation. So you're talking about the fact that, purchase applications are good. Part of that is people have more, options that they can choose from. Like you said, it's not like some giant amount, but inventory is up. So
my problem with the housing market in 2020 was that inventory broke to all-time lows, and it just had almost like, in a sense, a water slide down with no inventory growth at all. That does not happen. That was not a normal event. Of course, it's COVID, right? So the irony was in 2021, by the way, so I know a lot of people remember this, 2021 mortgage rates were near 3%. Everyone's like, oh my God, mortgage rates are at 3%. Everybody's going to sell their house. Inventory is going to explode. New listings data was
right
at near record lows. The inventory channel was somewhat normal, but no, it didn't work out that way. So I needed inventory to grow, and it's very hard in that environment. As you all can see, for those of you that's seen how we present inventory data is much different after 2010 than it was in the 80s, 90s, and 2000s, where we have rising sales and rising inventory. That is the chef kiss. If you get that back, you're in a great world. Here, because of qualified mortgage, the inventory channels we have now 14 kind of years of data on this to work off of. Again, 70 to 80% of sellers are buyers. You have 20 to 30% inventory left. So mortgage demand, millennials were the biggest home buyers in America. Like only 2 years in the last 11 did they lose that. That's when rates were elevated. The baby boomers took them. But when they buy homes, they don't give you a house. Elderly millennials can do that now. But so it was just hard to get active inventory to grow in that environment. But now we're almost there. Like I'm telling you, Sarah, when we get to 1.52 to 1.93 million NAR data, at least, there's no low inventory talk for me. You'll never hear me say that, because that's how I was in the last decade. There was plenty of inventory, right? Days on markets were fine, everything. Of course, the Northeast is much different than the rest of the country. They're still, so this is why I want 2019 active inventory, because even though it's not a lot historically, choices. Price growth doesn't go out of hand. So when the next time, when rates do fall to 6%, we have a better backdrop. There's more supply. We don't play the hungry hippo game. All that unhealthy, savagely unhealthy housing market goes away. So for me, just me personally, you have to be team higher rates to gain a benefit, and this is the benefit, right? Even though demand is still at record lows, history has shown eventually at some point the demand starts to rise. We're in a better backdrop for that to occur.
Okay, let's talk about existing home sales.
Existing home sales. Now, this is the interesting part. Our purchase application data that we're seeing is now year-over-year growth all the time. But our pending sales data, we have a total pending sales data that we show on the tracker. We also have a weekly version of it that tends to be a little bit volatile. That has only recently shown year-over-year growth. Now, going out for the rest of the year until October, the existing home sales is going to have a very, very low bar. Like 4 of the next 5 months are going to have under 4 million home sales from last year. So because that's the low bar, our pending sales data is actually showing growth. If existing home sales just stays on this trend, you're going to have like a few months of year-over-year growth. So anything better on that sense, and remember, purchase apps look out 30 to 90 days, you could get a little bit of growth out there. And that's kind of how we try to explain the purchase application data. That's kind of why we say that I think this report will have actually a miss in estimates. So it was a slight miss. When you look at the grand picture of home sales after November 9th, 2020, it's gone nowhere. It's just basically the bouncing ball off the thing. But this year is a little bit different because we never got rates down towards 6%. We've never had purchase application data grow on a year-over-year basis with rates this high. So encouraging. All this stuff is encouraging. But today, now the only thing is that my home price forecast so far. Now I use the Case-Shiller index as my metric. I'm not a big fan of median sales prices anyway, but some people will use the NAR data. Some people will use Zillow. Zillow tends to be lower than everyone else's because how they track their data with condos and everything, where Case-Shiller and FHFA is a single family. But so far this year, every single month, my price forecast has been below where the NAR data is. However, this month, it's 1.8%. I have 1.77%. So I need lower than what I forecast to make this year work for me. Last year, I thought that was going to be the case at 2.33, but when rates fell towards 6%, I lost my forecast. We ended up like 4% last year. But again, positive trend, right? Lower prices, lower price growth slowing down, more inventory, more choices, builds up the affordability better. So when rates do get to even 6%, you get a little bit better affordability curve going out there.
Okay,
the easy answer for me is always, if you could get sub 6% rates, you could grow sales easily from here. That's a given. But if I can't forecast it, I'm not going to model it out until we see labor breaking and jobless claims came out today. Still healthy. Still, we don't see any breaks in the labor market on that data line yet.
So I love that you're highlighting what the positive story is, because there is a positive story. We've seen that people had a really good month, right? A really good 2 months. But you just brought up the negative part, which is the rate. So let's talk about the macro environment and some of the other things happening that are keeping rates where they're at.
But by the way, the hilarious aspect, we had a 20-year auction. It wasn't even that bad.
But what do you mean auction? What are you talking about?
So there's a bond auction that goes off. That happens a lot. So there was a 20-year bond auction. It wasn't even that bad of a bond auction, but it looks like liquidity. We had corporate debts issues this week and everything. So bond yields went up 5 or 6 basis points, and everyone freaked out, even though the 10-year yield is basically not even at year-to-date highs. Sarah, we have way too many marshmallow men on social media sites. Oh my God. See, this is the problem. What social media has made men is become drama queens. Like yields go up. Oh my God, inflation. Yields go down. Oh my God, recession. Everything is bad in this set. And this has been going on for like 14 years. And this is like a cultural thing where guys go on social media and they become doom porn drama queens. And it's just like it's almost embarrassing. But I thought about this. Everyone is saying that, well, nobody likes Trump's budget plan. So so this is it. This is the main reason bond traders are like, because the debt is so big. I'm like, okay, 1990s house party, roll them up. Gee, bring them out. In the 1990s, debt was lower, debt to GDP lower, deficits were lower, 10-year and 30-year yields much higher. I just put the chart out at everyone. Everyone's like, don't know what to do. They don't know what to say. I'm like, go back, go look at the debt to GDP back then. Go look at the deficits back then. Go look at the debt. Much lower, 10-year yield, much higher. The 10-year yield didn't even really get to 480 until the 2001 recession. We had a brief pull down in the late 1990s because there was world market stress. But the 30-year was like a 9% at the early part of the decade. So if we're going to make it about debt and deficits and the budget, then we should be talking about the 10-year yield going to 6, 7, 8%, the 30-year yield going to 7, 8. And I show the chart. I got a lot of smart people on Twitter doing this. And then nothing. No, nobody knows what to say, because back then debt was a lot lower, rates were a lot higher. So again, we always like to keep this simple. 65 to 75% of where that 10-year yield can range is still Fed policy, right? Policy was much different back then. Inflation, if you look at the 1990s CPI headline, was like, I think a little bit above 5% in the early 90s, got down to 2%. Debt deficit still with a 2 handle on CPI inflation, 10-year yield much higher, 30-year yield much higher. So Fed policy still runs the show. And this can explain why the 10-year yield today is, I think the last time I saw was 456. So I woke up and I told you, is everyone okay? Everyone okay? Did everyone survive that 20-year bond auction? Really? And then it seemed like everyone survived. God. Oh, what marshmallows. How do you guys want to play ball when you're this soft all the time?
Okay, so let's walk through that a little bit. So, what you're saying is the economy still is doing really well. Like we're not seeing the job loss that we thought. Jobless claims didn't break, and that's what the Fed is going to base their next cut on, correct?
So 2 jobs reports ago, the labor data was fine. The labor week data was fine, and the 10-year yield was like shooting down lower because the Godzilla tariff, the market was not ready for Godzilla tariff, so it pushed bond yields below 4%. I almost got my entire 10-year yield channel already or filled out, and I was like, guys, the labor data is not. We should be at 435, right? So as long as the labor data is holding up, especially now that inflation expectations are rising, the Fed is telling us this, 435 to 470 is perfectly acceptable. Right? And jobless claims, still low. Continuing claims might be elevated from the lows, but they're still on a historically low basis. So the labor market isn't breaking. Now, if you're a labor market person, labor has to break over inflation. That's what you're looking at, which is very interesting because J.D. Vance gave an interview yesterday, and he was like, we were told that the dollar would go up if we did these tariffs. And that because the dollar would go off, the imports wouldn't be inflationary. So we have to show some humility. The economic profession. I'm trying to grasp this. Did Steve Myron actually tell them that if you do Godzilla tariffs, the dollar would actually go up much higher, and whatever you import won't have? So I'm assuming that that's what they're angry about. Because for Vance to do a national interview and say that is that we were told this and it didn't happen, so we're trying to figure it out. Boy, that's very telling. We always talk about the dollar's going to go down, right? If this happens, the dollar goes down 10-year yields. But in this case, they have the dollar lower. The 10-year yield is elevated right now for them. And apparently they weren't looking for the dollar to go lower out here. And now you could see why Trump is telling companies, hey, eat it. Eat the tariffs. Just eat it. Who was that singer back in the 80s? He did
what? Come on. Oh, you mean Weird Al?
Remember, just eat it.
Yes,
it was a spinoff of Michael Jackson.
Weird Al
Beat
Yankovic.
It. So
yes.
So who was that guy? It was the guy with the mustache.
Yankovic. Yes, yeah. Weird Al.
It's Weird Al. Oh, is Weird Al still alive?
He is. Yes, he
is.
Put out something Lord. I love Weird Al. Come on.
Okay.
Okay, so that's interesting because when you were looking at what they were doing, you said from the beginning, you're like, what they're trying to do with these tariffs is get the dollar lower. And so it was a surprise to you that you're like, oh, they didn't know that.
I couldn't believe it. I thought it was a joke. I thought people were like, I thought it was a spoof. They made up a quote or something. And then I went and I actually read the interview. I was like, what? Is that how they based it? See, now that just changes my whole my mindset. If they were really looking for the dollar to go much stronger and then do the tariffs and then kind of like, China devalues their currency to offset, what the US does. I'm thinking, oh, wow, that there's some drama going on in the White House if that's the case, because now you got the dollar lower, you got bond yields higher. That was not the game plan, right? And now you got to do trade deals, and Japan's holding back. I always thought like the news from Japan was actually more important. The trade deals with Japan aren't really going as well, and China was rattling some things. So very interesting week. God, it was really fun, because if you think about they went into this thinking the dollar would be stronger, but if they want to export stuff, they need the dollar weaker. Like, what's going on here? And then also now Freddie and Fannie, they threw
Yes,
that tweet
let's
last
talk
night.
about that because so just yesterday on this podcast, James Kleiman and I, he had been at the secondary conference MBA, and Bob Brooks was up there and said, yeah, we don't see any, we don't see this happening, we don't see an appetite for it, which is what we've all seen, that like they don't have the things in place, whatever. And then last night, like at, I don't know, like 5:30, 6:30, something like that, the president tweets out that he is giving it serious consideration to release Fannie and Freddie. And we're like, what? Where is this coming from? So give me your take, because I know you have a specific take on this.
I've always thought this is a terrible idea. I have written about this for many, many years. It is a functioning marketplace with them in conservatorship because they don't have to go out in public and raise $300 billion, right? They are making money hands and fist, and they're giving it to the Treasury, right? So there's no tax risk or anything. Boy, they're giving money to the Treasury out here. If it is true that they are going to try to create a government asset class, okay, this gets into a real different type of conversation with Freddie and Fannie. This is about the United States government taking Freddie and Fannie and saying, hey, do you guys want to own this? We'll give you preferred shares. We'll take the money in. Okay, so this is different. This isn't about the housing market. This is about, you need more money to go to the government to maybe get more money to the Treasury. If they are moving into an area to where it's more about getting more money into the hands of the U.S. as an asset class, that's a whole different thing than, okay, let's just get Freddie and Fannie out of government, take the Treasury off. See, if they took the Treasury backstop off, that's going to be very messy, right? Freddie and Fannie are just simply too big. So I'm assuming, because not a lot of things have worked out like the White House wants. If they're talking about this, I'm assuming they're going into this thinking they want to make Freddie and Fannie a financial asset that everyone in the world can invest in, or something to that nature out there. But I've not been a fan of getting them out of conservatorship, because not only do we not have to worry about them as publicly traded, because once you're a publicly traded company, you are shareholder first. And
Right.
when there's credit stress or market stress, you have to tighten your credit. I don't know if they could raise enough money and raise enough capital for it to work. And as a publicly traded company, you have to price risk much higher for places like Florida or places like Texas, So I want to see what the plan is. I assumed before, when they talked about, well, we can't do this without the Treasury backing it, then it's not like really getting the government out of lending. But if this is really about a financial asset class and doing preferred, it's a whole different ballgame. So I'm going to hold judgment until I see what the game plan is. But this looks a little bit different to me than what Mark Calabria wanted to do back then. But just remember that one of the greatest heroes in the United States of America was Mark Calabria, because Freddie and Fannie were in conservatorship. They had successful forbearance. All the lending was functioning well during COVID and everything. And he'll go down in history as one of the greatest government enterprise helping the United States of America. And I know he's going to hate that because it was government stepping in, not the private sector. So we'll see what the final outcome is. But now I'm just like, I don't know what they're going to do. And for them to say this now, this looks like to me that they are going to do something on the financial side with them to maybe make them because they make money, man. These people do make a lot of money, and they give the money to the Treasury. So we'll see how that works. But if they just make them publicly traded companies, and then the Treasury says, we'll backstop you whenever we need it, that's somewhat a workable case, because you don't have to worry about liquidity problems then. But I know a lot of people are asking about this after that tweet. I'm just going to say, let's just wait to see what the real game plan is here. For them to do it now means there's something else out here. But the fact that Trump says, I'm in serious consideration, that to me means he's not 100% in there yet. So we'll see what happens when they talk about this going out in the future.
Wow, wow, wow. So much. And it's only Thursday. We are recording this on Thursday. All of this happened in like the last couple of
It's
days.
been a good week. There's been a lot going on out there. So hopefully, for those that read the article, I try to give context on the purchase application data. It's like we're really using a very low bar. And last year, we had year over year, double digit year over year declines, but home sales weren't really like crashing or doing anything. So just remember, it's really rare in America for home sales to go under 4 million on the monthly side. We still haven't closed under 4 million. We're at such low levels of sales considering our household. That's why I always say it's the lowest home sales ever. When you take the workforce, household, everything out there, sales are so low. So it doesn't take much to move the needle. This is the year that for purchase application data, it really didn't take much to move the needle. But other positive things, again, if you're a pro supply person, this is what you want. The only caveat to all this is that today on Twitter, I talked about, because active inventory is growing, what you can make a case is that unless rates fall, housing construction is peaked in this decade. So that's the thing. If rates don't fall, single family permits where they were and single family starts for the rest of this decade, we shouldn't get there ever again.
That's not
Because
good.
there's more supply now, right? The majority of all supply in this country comes from the existing home sales market, and it gets harder for the builders, right? They had an advantage for a while. Their total completed units were low, active inventory was low. They could pay down rates. It's a little bit different now. So we talked about that on social media today, that you can make a really good case that housing construction has already peaked for this decade.
Logan, thank you so much for walking through all of those things with us. Of course, we will be talking again soon, and the tracker will be out this weekend. And people should come and see you at our amazing The Gathering event. We have an amazing couple of days out there at the Broadmoor in Colorado Springs. You're a featured speaker. Can't wait to hear your keynote. So people
Oh
should
my
come.
God, you just gave me an idea. I'm going to go on stage and go, just eat it. Just eat it. I gotta go back and get the words to that song and just have some fun. Yeah,
I actually know all the words to that song because my kids
you do?
loved Weird Al. Yes,
Come
we
on,
love
give
Weird
me
Al.
give me at least 2 lines. Come on, come on, come on,
You
Wheeler.
should not have said
No,
that,
Wheeler,
right?
come on. Don't. You said you do it. Just give me 2 lines. Just 2 lines.
No, I don't remember them off the top of my head, but I
No,
do know all the words.
no.
Okay, I'm not like you, Logan. Those things don't come so. But let me think. Okay, hold on here. So I remember when it said, okay, just eat it. Open up your mouth and feed it.
Gonna
So
be Michael Jackson
have
like
some.
like. Go ahead. Go ahead.
Have some more yogurt, have some more Spam. It doesn't matter if it's fresh or canned, just eat it. Yeah, I mean, it's bad. It's bad. I'm just telling you that
All
this is
right.
going to be something I regret. I can see that already. But yeah, there's something about like Captain Crunch, Raisin Bran.
Oh,
Yeah, all right.
Captain Crunch and Raisin Brands. Oh, bring me back to the 1980s again. Oh, I love it.
Yeah, now actually you see all the advertisements for like, oh, cereal, it's like your comfort food. It's like, yeah, because they used to feed us that and it was like, oh, this is your healthy breakfast. No, there's nothing healthy about that. So
Yeah, if
anyway,
you
all
if you ever
right.
want to know one of the biggest scams ever in history, it was the food pyramid ever created. If there was one thing that was absolutely just utter garbage, the food pyramid was the greatest fraud ever.
I know, I lived through that. Absolutely. Okay, well, it's always a pleasure, Logan. Thank you so much.